everyone, welcome to Magic Bricks, now India's first property channel. You're watching Property Hotline. I'm Kavita Krishnan. Today we are answering all your home finance questions with Harsh Rungta. Harsh is a chartered accountant and a SEBI registered investment advisor. Harsh, welcome to the show. We have retired Colonel P.S. Dillon, who's dialed in from Pune with a question. Colonel Dillon, tell us, how can we help you?
Yes, ma'am. Good evening, everybody. My name is Colonel Dillon. I have taken my early retirement from the Army.
Okay.
My problem is that we get a pension. I retired at 48. I have approached banks for home loan as well as a personal loan. But I have been told personal loan was clearly me because being a retired officer, although I'm 48, 52. Now, I'm 52 now. But I was denied personal loan as well as home loans were also, the banks were not very keen to give me home loans as well. So my doubt is that our pensioners with age less than 55 years and salary of about 50 to 60,000 rupees pension, are they eligible for home loans? This is my doubt.
You draw a pension, are you eligible for a home loan? Harsh, what do you say to that?
So, Colonel, I think that's a very relevant questions that you have raised. I mean, I think the key issue is that at a very young age, at a relatively young age, the pension has started. Now, whenever any bank gives any loan, and if you talk in the context of home loan, there are three things that the bank would look at, apart from, of course, looking at the property, which in your case hasn't come to. First is that whatever income you have, how reliable it is that it will continue in the future. That is one. Two, whether this income, when it continues in the future, will it keep pace with inflation? Okay, those are the two. And how, what are the chances that the person taking the loan will still be there at the time that the loan maturity is over? Now, obviously, in a case like yours, the pension is coming from the government. So, I think the consistency of that coming in, the reliability of that coming in the future is very, very high. I think it is the other two features, the feature on whether it will keep pace with inflation. I think it does increase, but it does not keep complete pace with inflation, which a normal working salary would. And third, of course, which is a much bigger problem, is if you look at a home loan, typically to be eligible for a big enough loan, you would need to take, say, a 15-year loan. Now, the chances that, the bank would need an insurance policy that if something happens to you during those 15 years, their loan would be repaid. And insurance at this age is either not available or it will be available at a fairly heavy cost. And that is the reason you have found.
So, Harsh, what can Colonel Dillon do in that case if he does want to buy a home now,
right,
and he is drawing a substantial income, which, like you also mentioned, is a benchmark to inflation in some way, because there is a dearness allowance revision that army officers like him and government officials are eligible for.
Correct.
So that the pension is revised. How can he opt for that home loan?
So, I think, Colonel, the good news is that it is not as if that you just can't get. You will be in a position to get a home loan. The quantum will be not very high because they will assume, say, 5 years. Now, in 5 years, because the EMI is very high, because you have to repay the loan in 5 years, the quantum of loan that you will be able to get might not be up to your satisfaction. So, the way in which most lenders are able to do it is that if you take this home loan in conjunction, say, with your children who are younger and who have an income, then they will consider your income, your children's income. It also allays the concern in terms of who will take the liability.
So, the children need to come in as a co-borrower?
It will improve the eligibility. He can get a loan on his own, but if he is able to, say, get only a 5-year
loan. So, Colonel
loan.
Dillon, these are your options. Either opt for a short-term loan, one that, that you will be able to repay in 5 years or so, though the loan quantum that you can be eligible for will be far, far lesser, or else get one of your children to join in as co-borrowers. That will up the amount of loan amount that you can actually get from the bank. That will also enhance your loan eligibility in the eyes of the bank. Let's move on. We have a question that's come in on loan transfers on our website www.mbnow.in. Mr. Fernandez says that he plans to transfer his home loan from HDFC to SBI. Now, he wants to know, will he have to pay any fee to transfer the loan? He also wants to know whether he lose any amount in the home loan that he's availed from HDFC, because only the first disbursal on this home loan has been made, and that too was on a pre-EMI basis. So he's shifting the home loan at a very, very early stage.
So I think in terms of charges, clearly there are, if I am assuming it's a floating rate loan, and if it's a floating rate loan, there will be no charges when you shift your loan. You can shift it even at a pre-EMI stage. SBI will obviously have to have approved that property, because it's still obviously under construction. So that property needs to be approved by them. Otherwise, they will be able to shift whatever has been disbursed, and they will undertake to disburse the balance amount. So I mean, shifting is of the existing loan, plus they will sanction fresh loan to be given, which will be disbursed to the builder. In terms of charges, no charges from HDFC. There could be a processing fee charge from SBI, or there could be a mortgage creation charge, depending on the state. Some states have that charge. In Maharashtra, it is 0.2% of the loan amount.
Also, Harsh, before we move on, very quickly, at an early stage of your loan, does it really make sense to move it from one HFC to the bank, like Mr. Fernandez is trying to do over here? Only one EMI has been disbursed. They've only made one disbursal. Sorry, it's not EMI. They've only made one disbursal till date. Does it really make sense to shift at this stage?
So one doesn't really know why he is wanting to shift. I am assuming it is an issue with the rates. If it is an issue with the rates, then it does not matter at what stage you are. In fact, because it is the new rate is going to apply even to the disbursements that will happen in the future. So it's better to shift. If he has a problem because there is some issues with the property, then that is something that he needs to examine in a far more careful manner.
Right, and since we are talking about shifting home loans over there, those are the current interest rates up for you on the screen, and HDFC Limited is giving a 9.4% interest rate. Meanwhile, SBI is charging 9.35% currently. Those are the rates over there. BOB is quite high at 9.65%. So those are the rates over there if you want or are in the market to take a home loan. Let's move on. Sanjay has dialed in from Delhi. Sanjay, how can we help you?
Ma'am, good evening. Thanks for taking my call, ma'am, firstly.
Yes,
hello.
go on.
Hello. My query is regarding, there's a this initiative by the Investors Clinic. What they are offering is they've got certain properties in NCR region, wherein their plan is they'll be providing the property to us without any interest. I mean that the loan component 20% we pay, rest 80% will be converted into 100 equated installments, and you're only paying the the principal component of the loan. So if I take about 40 lakh loan, then it will be 40,000 for 100 EMI. So I just wanted to know about how good is this scheme, and should we go and invest in this kind of scheme?
So Sanjay, essentially what you're saying is this scheme allows you just to pay the principal and not the interest on that loan.
Yes. And they've got a limited number of properties. It's by all the builders like Supertech, Aditya, Lajanara, and all.
Have they tied up? Have they tied up with any specific bank or HFC? Have they told you about this?
Yes. It's through Indiabulls, what they're mentioning.
It's through Indiabulls. Okay, so they've tied up with Indiabulls and they're offering interest-free loans. Is there something like an interest-free loan in the market, Harsh? Is there a product like that?
Well, if interest-free loans exist, Tooth Fairy exists as well. My point is, obviously, somebody is paying that, and that somebody is you. It is just a question of how it has been packaged, right? So, I do not know about the specific scheme that he has mentioned. There could be issues here. The interest could be paid by the builder, right? And you are required to pay off the installments. I think the key issue here is who's taking the risk of non-payment by the builder. If the developer is paying the interest, then who's taking the risk? That is why that the tripartite agreement would need to be seen in terms of what happens if the developer will not pay the interest to India Bulls. India Bulls is not going to give a loan without interest. So very clearly the developer is picking it up, and that if he does not pick up, how will it affect you? That's one. The second is your payment dependent on the construction timelines. Now in a typical construction linked plan, you pay only to the extent the construction progresses. I mean, the disbursements happen only to the extent that the construction increases. Here, if for any reason the lender has completely disbursed the entire loan, then whether or not the construction progresses, whether or not there is a delay, your liability to pay is absolute. So I think those are two things that you need to check. And I would personally be wary of any marketing schemes.
Basically,
such
Sanjay,
as
it
these.
sounds very nice, but you need to remember that if somebody is giving you a loan, the money for that loan has come from somebody else's deposit, or they have raised funds from somebody else. That is what they are lending to you. So essentially, it's somebody else's money that they are lending to you. So they are going to charge interest on it. That is a cost that they are paying for it, and they are going to ensure that the cost comes from you. Now, whether you pay it, whether the developer pays it, it's a different thing altogether. Also, what you need to remember is that the developer is not going to foot the interest payments for free. The developer is going to ensure that that money is going to come from you in some way or the other. So you really need to read the fine print before getting into any scheme of the sort. And like Harsh said, you need to keep in mind that if there is a delay in payment, then it will be your record that is on the line. It is your CIBIL record, your CIBIL score that is going to be on the line, and that will definitely be a blot. How long does it take to set your CIBIL record right, Harsh?
This one you can't set right, because if you have a liability to pay and if you don't pay, how can you set that right? You can only set it right by
For no
paying.
fault of yourself.
But no fault. You thought that was not your liability. That's why I think this is inbuilt into the price. So try this. Tell them you're willing to pay cash. You don't need this loan. You're willing to pay one-time down payment. I bet you it will come at a big discount. That's the discount that's the interest that's inbuilt into the price.
So Sanjay, essentially read the fine print and be very wary of schemes like that. And key takeaway for all our viewers who've tuned in, there is nothing like an interest-free loan. If you take a loan for a period of time, you have to pay the interest for using that money which would have ideally if been given to somebody else, and the bank would have made money, lending that money. So you need to pay interest on a loan. If it is not taken from you upfront, you are paying for it anyway through some other means. So that is something that you need to keep in mind when you get into schemes like this. Phone lines ringing off the hook, I'm told. Kamal has dialed in from Mumbai. Kamal, how can we help you?
Yeah, hello ma'am. Ma'am, I was going through one of your episode. I had a query regarding loan in the investment in the stock market. As you know that investment in stock market is a high risk, high reward thing. One of the experts said just that if you are having surplus cash with you, don't repay your loan. If you are already having any liability of any loan, housing or personal loan, instead invest your money in a mutual fund. So I'm a little skeptical about that advice. I would like the suggestion, opinion from the expert that would it be good to put your cash and continue with the liability instead of
Kamal, that's a great question, and I'm really happy that somebody turned around and decided to question the experts. We hear this very often, Harsh. Experts come in and tell us that you should not pay off your home loan if you have a surplus invested in the market. Now, Kamal has a point there. It is a high-risk investment that you're making unless it is for the long term. Now, explain to him the logic behind what experts are telling us.
So let me give you an economist's answer, which is both ways. Okay. First, if the money that you save if the money that you have that you can either prepay or invest in the markets, and if your investment is short term, and by short term I mean anything less than 5 years is short term, right? The returns from stock markets are good over the long term. I mean 8 years, 10 years, that is the kind of term it requires for you to get a good return. If you're thinking of less than that, then you're comparing apples with oranges. On the one hand, you're looking to save the interest cost on a home loan versus you're able to take a big risk on that. I don't think you can compare. So I think that answer, that question itself isn't really correct. If you have the ability to take the risk because you want that kind of a reward, do it. Otherwise, the answer is very, very clear: prepay. But why do the experts recommend what they say? That the cost of a home loan typically is about 9.5% today. If you typically get a tax deduction for it, assuming the entire interest is tax deductible and that your income is high, which means your taxable income is more than say 10 lakhs, effectively you're paying 6.65 post tax. If it is 20%, you would pay say 7.5. If it is 10%, you would pay roughly 8.75, and so on. Or even if you are in the 0% tax bracket, you're paying 9.5. On the other hand, if you systematically invest in equity for the long term, over 10 years, right, then the return can be as high as 15%. And that's what it has been in the past. And that is the reason.
And this is 15%. Let us make it clear for Kamal.
Tax-free.
This is 15%. Also, you are getting it over a 10-year period. We are not, the experts are not advising investment for a year, for 2 years or for 3 years. They are asking you to hold it for 10 years or more, and that is when you will see substantial returns. Essentially, Kamal, what the experts are also telling you is that you need to make your money work from you. Now, the home loan is one of the cheapest loans that are going in the market. It is a liability, I agree, but it is also a liability that gives you a tax deduction, which is why, as a working professional if you are in the first half of your career, if you've just begun in your career and you take on a home loan, it might look like a big ask for you to pay off that EMI. But if you pay off that EMI over time, it starts pinching less and less. Also, you will start enjoying the tax deduction that you're getting on that home loan. And simultaneously, if you set your money to work for you in the capital market, you can then use that money at a later date to, prepay your home loan. So once you're like Harsh said, once you've stayed invested in the market for 10 years or more, you can then take that money out and probably prepay a home loan. It probably makes more sense at that point in time, right, Harsh?
Absolutely. So if you're prepared to stay the long term, then follow the expert's advice. Otherwise, just prepay the loan.
So net, make your money work for you. Question coming in on our website now. Rekha says that she recently took a home loan. Now she plans to repay it within 1 or 2 months. Can she do so? Recently took a home loan. She doesn't tell us how long back this was, but she says plans to repay it within 2 months. So I'm guessing she's in the very, very early part of her home loan. Make sense?
I think we see this increasingly now. People who can afford not to buy a house even without a loan, they take this loan just to make sure somebody does the legal checkup of the property for free. Effectively, or it's part of the small processing fee that they have to pay, and then they pay off that loan within 1 or 2 months. And today, because there is no prepayment charge, I think that's an arrangement that works out well for them. It doesn't work out very well for the bank because it incurs a whole lot of upfront expenditure when it takes on a client, which they are hoping to recover over a period of time. From a client perspective, can she do it? Of course she can do it. Should she do it? That depends on what is the reason for her wanting to prepay the loan. We unfortunately don't know the reason.
Right. However, Harsh, this entire issue of relying on the bank to do the due diligence for you on a property. Now, we routinely ask, buyers and investors who call us, we tell them that before you put in your money, please do your own due diligence. And go to a lawyer, go to a tax expert, go to a banker. Now, completely blindly following a bank. And every property in the market, in fact, is bank approved. Does it make sense?
I think, Kavita, that's a yes and a no. I think the key issue is that when people, the availability of information, and hopefully that will change once Real Estate Regulation Act is implemented, but the availability of information to a lay person is so low and the cost of getting expertise is so high. I think a project that is approved by 2-3 major banks, I think is a reasonably safe bet. I think it is a reasonably good surrogate for doing the check. It is not fail proof, the liability remains yours. If there is a problem, you would still have to pay the loan to the bank. Just because it is pre-approved doesn't mean that your liability is absolved. This is just one way of doing a sanity check.
So essentially what Harsh is telling you here is that a pre-approved home loan, or if a project is pre-approved, it doesn't mean that the bank is guaranteeing the project. It just means that the bank sees enough merit in lending against that project, and it expects that it will get its money back. What the bank is essentially doing is ensuring that its loan is paid back. You should not completely rely on the bank when you are buying or investing in property. You need to do your own due diligence. Kishore has called in. Kishore, how can we call you? How can we help you?
Yeah, I just wanted to understand. I'm a salaried person.
Mm-hmm.
Okay, I'm right now I'm having 2 flats. One which I'm staying, the other I've given it on rent.
Okay.
Is it advisable to buy a third home, or is it better to go for an investment in stock market? The period that I'm looking for the benefits is 10 years.
10 years. Now, that's a call that ideally you should be taking yourself. But yes, Harsh, what would you tell him to do? What would you ask him to do?
I think clearly the way one should look at this is not an answer. There is no one asset is better than another or one investment is better. I think you have to look at your overall portfolio. From what you are saying, just simply from what you are saying here, you already seemed, apart from the home that you stay in, which at least in my book does not count as an investment, but the other house that you have, that's an investment. Depending on what other investments you hold, whether in the stock markets, in gold, in equities, direct equities, in mutual fund, equity mutual funds, etc., fixed deposits, I think you should look at what that composition should be, and if there is a misalignment, then obviously you should take a decision based on that. So if your real estate is already high, then maybe you should actually invest in equity. Do it systematically. Time horizon appears excellent. You are already talking of 10 years. So the time horizon is excellent. Just make sure that none of the assets overpower another. So equity should not overpower real estate should not overpower equities.
Don't put all your eggs in one basket. However, Kishore, we are a real estate channel, and let me give you my 2 bits here. I can tell you this, that it might actually make sense for you to go ahead, invest in equity for the next 10 years, make your money, take that money, the money that you would make by selling this home, and put it together and buy a bigger house. You can also look at doing that. You never know how your investment goals may change going forward. But one thing that you do need to keep in mind is that investment is a long-term habit, and plus it is something that you need to keep revisiting. You need to keep revisiting your goals. It's only then that your investments really work for you. And we are running out of time here on Property Hotline. But before we end, key takeaways and lessons that we learned today on Property Hotline. There is nothing like an interest-free loan. You must pay interest for using that loan amount, for taking that loan. So if somebody is promising you an interest-free loan, that means it's a red flag for you to read the fine print. That's all the time we have, like I said, on today's episode of Property Hotline. Harsh Rungta, thank you very, very much for coming in and breaking down all those questions for us. If you have any questions related to real estate, whether it's about buying, selling, investing in property, legal issues, tax queries, or home finance questions like we answered today, you know how to reach out to us. IDs are flashing on your screens. We'll get the country's top experts to answer each and every one of your questions. That's a promise. Thank you very much for watching. Stay tuned to Magic Bricks now.